Hey everybody, so I'm here to talk to you about this book I'm reading. It's called First Responders. It has to do with first responders to the financial crisis from 2007 through 2009. It's the primary authors are Bernanke, the former chairman of the Federal Reserve, Timothy Geithner, and Henry Paulson, both former Secretaries of the Treasury. There's a lot of other authors in here as well. There's like many chapters, and each chapter is written by different financial experts, usually 2 or 3 or 4 financial experts together, and they're writing about a different topic pertaining to the financial crisis. And then these 3 guys have kind of input in all those chapters, but they wrote the first chapters themselves, and I'll share some highlights. It's interesting if you want to know what happened, if you want to know more about what happened leading up to the financial crisis and how they fought it, and also anybody in the financial world, especially in the government, that are going to be, having something to do with a future financial crisis. If they're in a position where they're going to be making decisions on what to do, they need to read this for some advice. So I'll mention one interesting thing that when I started reading the book, it's kind of on another topic, but I'll just share this sentence with you. It said, these guys, they say that the U.S. government has emergency protocols in place for responding to disasters like pandemics or terror attacks, but it lacks a basic playbook for containing damage from financial disasters. And I'm kind of thinking when it took me on another topic of the pandemic, when it says they have protocols in place for responding to disasters like pandemics and terror attacks, but we're in a pandemic, as they say, and I don't think those protocols worked too well, or they weren't even there, but that's a whole nother topic. So now one thing I'll start off, here's a couple other sentences, and then I'll talk about it. It's and again, this is these 3 guys speaking, Bernanke, Geithner, and Paulson. It says, for all of our experience with the theory and practice of crises and crisis management in academia, markets, and government, we still fail to anticipate the worst crisis of our lifetimes. Our analysis gave insufficient weight not only to the possibility of a nationwide decline in housing prices, but also to the risk of a broader loss of confidence in the stability of the financial institutions. Now this is what's really annoying to me, is how could these 3 guys and all those other so-called experts not see that there was going to be a decline in housing prices? You have low interest rates, you have all these crazy different types of loans. They kept coming up with newer and newer loans where you could put less and less down, and even these interest-only loans. But these newer, these loans that they kept coming up with, these mortgages, would allow people to borrow more and more money, so people could come to the table to buy a house with more money. Well, obviously that's going to inflate housing prices because people are competing for these houses and they're bringing more money to the table, but it's not their money. They should never have had access to that money in the first place. And then, of course, when the first domino fell and dominoes started falling, obviously the prices were going to, the price bubble would pop eventually, and then it would fall. And they say here that they just couldn't foresee that, which is incredible to me. It's just, and then the former chairman of the Federal Reserve, Alan Greenspan, sent in an interview when he was asked about these mortgages, why couldn't you foresee the coming crash? He said, well, I guess I just missed the boat. I don't know how you can just miss the boat when you're the most powerful finance guy on the planet, but anyways, I found that disturbing. But so I'll get into some of what they talked about. One of the topics was shadow banks, and these are non-banks that don't have the security of insured deposits from the FDIC. and that never run, meaning, they don't, regular banks have that deposit insurance, so they don't have to worry about a bank run as much because they know that their depositors know that there's insurance there. They're insured up to $250,000. And these non-banks also do not have effective regulatory constraints on their leverage, and they don't have the ability to run to the Federal Reserve for help. So this was a big part of the downfall of the financial crisis. One of these shadow banks is Countrywide Financial, or was Countrywide Financial. They reorganized as a thrift in order to enjoy the lenient oversight of the Office of Thrift Supervisors. This, so they reorganized, and so they could be regulated by this, Office of Thrift Supervision, which was a joke, and they have since been abolished. Countrywide Financial, at the time leading up to the crisis, was the leading mortgage lender in America, and they were responsible for the origination of 1 out of every 8 mortgages in America. And of course, I forget who bought them, maybe Bank of America, I don't remember, but they no longer are around. And but they were getting into those really risky mortgages, and their founder and CEO, Angelo Mozzino, was just a greedy shark. And anyways, that's another topic. But there was also no, again in this book, what I read, there was no single regulator responsible for safeguarding or even monitoring the safety and soundness of the system as a whole. No supervisor had visibility into the entire system of non-banks and banks. So the system was a failure from the beginning. The FDIC had emergency authority to wind down failing commercial banks, but no one had the authority to step in to avoid a chaotic bankruptcy of a major non-bank. They did not have the authority to inject capital into a non-bank or to guarantee its liabilities. So again, these non-banks were a huge problem waiting, it was a huge bomb ready to explode. The institutions with the most marginal mortgage holdings and the least stable funding bases also had the thinnest capital buffers. So that was a recipe for disaster. And in 2005, banks and thrifts under federal supervision originated only 20% of all subprime mortgages. So again, the institutions with the most marginal mortgage holdings and the least stable funding also had the thinnest capital buffer. So they had the highest risk with the least amount of safety net. So that was a recipe for disaster, and most of those were non-banks, the shadow banks. And it said here that real banks with FDIC supervision only originated 20% of the subprime mortgages, meaning 80% of those subprime mortgages were originated by non-banks. So, the riskiest mortgages were originated by the riskiest banks that were non-banks. Now we'll talk about Lehman Brothers. First we'll mention Bear Stearns. Bear Stearns was pretty much on the precipice of going under, and they're a non-bank, they're a big investment bank, and they were about to go under. The Federal Reserve couldn't, they couldn't do much because, like I just mentioned, they were a non-bank. So what the Federal Reserve and the Treasury were trying to do was to find a buyer for Bear Stearns, and they found J.P. Morgan was willing to buy them. J.P. Morgan bought them for $2 a share. And then our government lent $30 billion so they could pay the creditors of Bear Stearns. And so basically they did that to contain the fire right in this little circle with Bear Stearns and J.P. Morgan, because if they hadn't lent that $30 billion, then those creditors would have gone bust, and then their creditors would have gone bust. It would have been a domino effect. It would have spread like a wildfire, but they lumped that $30 billion to contain it into this circle. And then Lehman Brothers, the government did not, a lot of people, there was controversy over this because a lot of people, including the former chairman of Lehman Brothers, Richard Fuld, he claimed in front of Congress that the government let them go under. They should have been saved like Bear Stearns. Well, they couldn't. Again, they were a non-bank, so they didn't have the tools to just save Lehman Brothers. They were trying to do what they did with Bear Stearns and find a buyer for Lehman Brothers. But there was a bank in England, I forget the name of it, but they were going to possibly buy Lehman Brothers, but then they pulled out. So there was no buyer for Lehman Brothers. So they just had to let them go. They couldn't do anything about it. The government, like it says in the book, the government did not choose to let Lehman Brothers fail. The government still had no way to inject capital or guarantee the liabilities of a failing non-bank to avoid default. They were trying to find a buyer. And in 2013, a study concluded that Lehman's capital hole was as big as $200 billion. So if the Federal Reserve were to just inject, or the Treasury were to just give money to Lehman Brothers, it would have required at least $200 billion, and that still may have not saved the company. So then, so again, that's one thing that was pointed out in this book. They didn't just let Lehman fail on purpose. But again, I'm glad they did fail, because Richard Fuld, was a horrible person. I equate him with the devil. He was just horrible, and he didn't deserve to survive. But then we get into the topic of stress tests. That was interesting, again, in this book. The stress test topic was, they go into depth in here, and it was interesting because under the Obama White House, Timothy Geithner, who was then Treasury Secretary, him and the others came up with the idea to do stress tests on banks to see how they would do in a depression-like scenario. This was a risky move because a lot of people said this could cause, one of the things when they do the stress test, they would release the results to the public. And that was risky because if the results were bad, that would cause a further run on the financial world and cause further problems. The Tarp money would run out quickly. But Timothy Geithner said, all the analysts and experts were already looking at the worst possible scenarios being the case. So if the results came back better than those worst case scenarios, then that would be a positive thing. And that's what happened. They did the stress tests, and the results came back and they did the stress tests on the 19 biggest banks of America, and the results came back that 9 of those 19 banks would not need any more capital infused into them if a depression-like scenario occurred. And keep this in mind that they had already gotten money, and there were rules put into place. But 9 of these 10 banks passed the stress test. The other 10 would need a total of about $75 billion in capital raised to survive a depression scenario. So what they did is they gave these banks 6 months to raise the capital themselves, and if they didn't raise it, then the Tarp money would be given to them. They raised, 9 of those 10 banks raised the money. The only one that couldn't was GMAC GMAC financing, and they gave them a modest amount, and over time that was eventually repaid with a $2.5 billion profit to the Treasury. So that worked out. So, but once these tests came back pretty good, investors came back to the banks and the balls started rolling again. So the stress test was actually a good move, and it helped get things going again. And then here, the Tarp programs for banks and insurers would end up earning $50 billion in profit for the Treasury. So all that Tarp money was replayed and then some, another $50 billion. So that worked out. And then overall, the government's financial interventions would produce about $200 billion in profits for taxpayers. So it all worked out. They did the right moves. Everything worked out. It's just from the beginning, what I didn't understand is they say they didn't foresee this tidal wave of financial problems coming, which I don't see how they could not have seen this. It's just beyond me. It didn't take. It's not a rocket science. You know, it didn't take an expert to figure this out. That's the big question mark I have. In 2010, the DoddFrank Act was passed, which brought in a lot of changes which are good, and then Basel III regulatory reforms for the international banking scene. The Dodd-Frank curled rather than expanded the government's crisis fighting tools. Now, the Dodd-Frank Act, did a lot of good things, but the problem is the financial industry is pushing hard for regulatory relief. Well, they do that in good times. And again, this book was written before the pandemic, so I guess these aren't good times right now, but right before the pandemic we were in good times, and so the financial industry wants to get rid of these regulations. Well, those are our safety net. You need to keep those in place, so when we hit another financial crisis, but that's what happens. They get greedy and they want to do interest-only loans again, and it's like a trapeze artist doing the trapeze and not falling into the net for 10 years, and then one day they come in, the net's not there because they're getting a new net installed, but they figure, I can do the trapeze anyways because I haven't fallen in 10 years, and then that's when they fall. So also we have less weapons to use in the next financial crisis. One of the biggest weapons you use is to be able to lower interest rates to spur the economy, but interest rates are already at zero. The Fed fund rate's at zero right now, so that weapon's gone. And then another weapon you use is tax cuts and increased spending to spur the economy. Well, during a good bustling economy, we had a major tax cut and with no decrease in spending, which is a mistake. You need to save that weapon when you have bad times. So when there are bad times, you can cut taxes and spur the economy, put more money in people's pockets. But we already did that, so that was a mistake. And then they say in the book, which again was written right before the pandemic, you have the other option of quantitative easing, where mortgage-backed securities and U.S. Treasury securities are bought by the Federal Reserve to decrease, to get more money in the system for the economy and to decrease the interest rates. But that, right before the financial crisis, the Fed balance sheet was $870 billion. Then it ballooned up to $4.5 trillion in early 2015. As of this past September, it was at 3.8 trillion, so they started paring those investments back. But then they started doing more quantitative easing in this past October at $60 billion a month because of a dysfunction in the market for repurchase agreements. And then the virus hit and the Fed dramatically increased. They did a new $700 billion program, and then Bottom line is the balance sheet of the Fed has now ballooned up to $7 trillion, thanks to the virus and others, and it's expected to top out at near $10 trillion. So that weapon, quantitative easing, is now also off the table to fight the next financial crisis. So all these government weapons are off the table, and that's a problem. So we're going to need a lot of luck in the next financial crisis. So anyways, I know the camera's about to quit, so again, I would read Responders, First Responders by Bernanke, Geithner, and Paulson. And that's all I got for now. And it's a great book. You'll enjoy it. Thank you.